Major stock market indexes like the S&P 500 and Dow Industrials are trading near all-time highs. And you know what else? Value stocks are leading the way. We'll examine that, plus dividend income strategies. Don't go anywhere, stick around. I'm Alex Mendoza with ETF Guide. Thank you for joining us. If it's your first time watching, hit the subscription button and post your comments below. We love talking to viewers. We've got a lot of ground to cover on today's show. How can you squeeze more income out of your investments? And what's behind the resurgence in value stocks? And will it last? Here to talk with us about that and much more is Lance McGray, head of ETFs at Advisors Asset Management. Lance, welcome back. Great to see you.
Thanks for having me.
Okay, great. Let's get started. We've seen a massive leadership change in the stock market this year, with value stocks now outperforming growth stocks. Last time you visited us, you mentioned the switch from value over growth was something investors and advisors should be ready for. That's been a great call. What's been driving value stocks higher, and does it continue?
Yes, the long-awaited rotation from growth to value has arrived, and we think it's here to stay, at least for a while. So far in 2021, most value strategies have easily outperformed their growth counterparts. And the relative outperformance is even more drastic when you compare concentrated value portfolios versus their broad-based peers. A great example of this is the AAM S&P 500 High Dividend Value ETF. The ticker is SPDV. It's a value-oriented ETF which targets 55 stocks that exhibit both high dividend yield and dividend sustainability characteristics. On a year-to-date basis, SPDV is up over 21% and currently sits in the top 5th percentile in performance against 1,200 funds in its Morningstar large cap value category. So what is driving this change in leadership? First and foremost, the economic recovery, higher interest rates, and signs of inflation all favor value stocks over growth stocks. Worth noting is the fact that value stocks have outperformed their growth stocks peers in every economic recovery since 1929. And this is no different. In terms of higher interest rates, this is generally a headwind for growth stocks as it hampers their valuations. The valuations of growth companies depend heavily on cash flows expected far into the future. For this reason, growth companies are deemed to be longer in duration and may lag their shorter duration value stocks in a rising rate environment. Couple this with the fact that dispersion between value and growth stocks reached extreme levels, all-time highs pre-pandemic, and it shouldn't be a surprise as to why we are experiencing this reversion to the mean. At AAM, we feel that rotation from growth to value is a long-term trend. We believe a pullback in value stocks in the second quarter is potentially a buying opportunity for those who may have previously missed the boat in the past. We certainly see more upside in value stocks, and we look for this trend to last a while, even if it doesn't show its face every day.
Perfect. So let's shift to portfolio positioning. With the strong performance over the last decade with growth stocks, investors don't want to completely abandon these growth stocks and the benefits that they offer. So how do investors position their portfolios to capture both value and growth in these uncertain times?
This is a great question. And the fact is, the world is changing. The way we socialize is changing. The way we transact is changing. The way we work is changing. There's a tremendous amount of innovation and advancements all around us. While this provides a fertile ground for growth companies, this doesn't mean that everyone should be focusing on IPOs or SPACs, nor should this mean that we are going to be ignoring most valuation metrics like we have for the better part of a decade. I would argue the recent resurgence in value stocks has opened up eyes of many growth faithfuls. We are seeing many financial professionals, financial advisors who are capitalizing on this opportunity to pare back their growth exposure in favor of value stocks. In many instances, these advisors, these professionals are taking a barbell approach where they are looking to utilize the benefits of both growth stocks and those of value stocks. Now, I must say, I must admit, this is very daunting task for many because they need to relearn the benefits of value strategies. But here at AAM, we think this is certainly one thing that we feel confident in and will certainly be beneficial in the long run.
Thank you for explaining. Let's move on to recent performance. Bond investors have been hit with losses this year due to the uptick in interest rates. Yet, one corner of the income market that's done well and is an excellent alternative is preferred securities. The AAM Low Duration Preferred and Income Securities ETF has been a star performer over the past year versus the US Bond Aggregate Index. Please tell us more.
Yes, PFLD, the first and only low duration preferred ETF currently in the market, may be a great alternative for those investors seeking high tax efficient income without significant interest rate risk. Now, preferreds often are underutilized by many investors, but they can play an extremely valuable role in one's portfolio to help generate not only additional income, but offer additional portfolio diversification as well. Now, when most investors think about risks associated with preferreds, they immediately think credit risk, or they may even think call risk, but often duration risk is overlooked. The fact is, despite the optionality built into preferreds are generally have longer maturities, often 30 years or more, and in some instances have no maturity date at all. With that said, they should be viewed as long-term investments, and for that reason, they are generally more sensitive to interest rates when rates rise. Now, one of the great things about a rules-based strategy like PFLD is that you know what you're getting. You know exactly it won't deviate away from its underlying index, and you know how the strategy may perform in certain environments. Let's take an example. Let's look at the first quarter of 2021 when the 10-year climbed from 91 basis points all the way up to 174 basis points. Now, one would expect with PFLD, given its low duration focus, you would expect that it would perform relatively well against its longer duration peers. And that's exactly what it did. And by the way, it did it with less volatility as well. As of 3/31, PFLD had a very attractive yield of 5.17, and its effective duration was 1.20. You contrast that with its ETF peers in the marketplace, and it's extremely attractive combination of both a high level of income and low interest rate risk. Many of the preferreds in the marketplace right now have a duration anywhere between 4 and 6. So PFLD's at 1.2 is extremely attractive. For this reason, PFLD may be a timely tool for investors who are seeking additional yield and worried about impact of rising rates.
Awesome. One final question, Lance, before you take off. Financial advisors would like to know what other advisors are doing. There continues to be a ton of interest in dividend income strategies by their clients. So what are you seeing trend-wise with how advisors are allocating client investments?
It's really interesting because at AAM, we are in front of hundreds of advisors on a daily basis. And over again, there are 3 major concerns that come up in the majority of these conversations. The first is, I'm overweight growth and underweight value. How can I best address this? The second question or concern that comes up frequently from a lot of financial advisors is, my clients are starved for income. Where can I find elevated levels of income in this low rate environment? And finally, the third one that comes up fairly frequently is, how should I position my client's portfolio in a rising rate environment? These are some of the questions that we get on a daily basis. And more so than not, they come up almost in every conversation we have with financial advisors. In terms of the overweight growth and underweight value, we are seeing a lot of financial advisors really utilizing the benefits of the ETF wrapper, right? The transparency, the liquidity, and most importantly, the tax efficiency of the ETF wrapper to help transition one's portfolio from a growth-centric portfolio to one that can be potentially a value-centric portfolio, or one that blends the two together. The ETF wrapper is a fantastic wrapper to do such a thing in someone's portfolio. With that said, though, you need to be aware of the underlying strategy. Understand the nuances, the risks associated with each ETF that you look at. There are thousands of ETFs out there. There are hundreds of value ETFs out there. Some are concentrated, some are not. Some provide elevated levels of income, some do not. Make sure you understand what ETF you're getting into and the exposure that ETF is giving. Number 2, when it comes to income, the one thing that we always talk about is, don't be afraid to explore alternative sources of income, including preferreds and equities. right? With that said, it's important that you understand the risks, as I mentioned before, but in this low rate environment, you need to get creative in terms of where you're looking for that additional income. And finally, how should I position my client's portfolio in a rising rate environment? This is something that we have not had to deal with in quite some time. And this conversation in question is coming up all the time. What I would say and what we tell advisors all the time is this is all about managing your duration risk. Of course, one needs to take on duration to achieve any level of income, but it's important that you do not take additional duration risk if you are not getting rewarded for it. A perfect example of this is the PFLD, our low duration preferred ETF. This is an ETF that provides all the benefits of the majority of the preferred ETFs out there, but it has a quarter of the duration risk of those. And therefore, in a rising rate environment, PFLD will not have as much duration risk or exposure to rising rates as some of its peers. So it's all about understanding your portfolio, understanding your risks, and then understanding the tools at your fingertips to manage your portfolio and navigate the client's portfolio.
Excellent. Thanks, Lance, for dropping by and sharing your insights.
Thanks for having me, Alex.
Keep up the good work. Be sure to visit aamlive.com to learn more about the ETF lineup at Advisors Asset Management. The link is posted in the description section below. Don't forget to subscribe to ETF Guide TV. Tell us how you've been enjoying our timely programs like this one, along with ETF Battles and the many others. You can also find us on Twitter at ETF Guide. I'm Alex Mendoza. Thanks for watching. We'll see you soon.